The wealth destruction pattern. How 89% lost everything in 1929-2008 and will again in 1929. 89% of American investors lost everything. In 2008, the average retirement account dropped 52%. In 2025, the same pattern is forming. Same warning signs, same psychological traps, same wealth transfer from the majority to a prepared few. Let me show you the pattern they don't want you to see. There's a mechanism in financial markets that repeats with mechanical precision every 15 to 20 years. It's not random. It's not unpredictable. It's a psychological and structural pattern that destroys the majority while enriching those who recognize it. The majority always loses because they fall into the same behavioral traps. They believe this time is different. They trust authority figures who have incentives to keep them invested. They ignore warning signs that seem obvious in hindsight. And they hold their positions through catastrophic declines, watching their wealth evaporate. This happened in 1929, when ordinary Americans lost their life savings, while a small group preserved and multiplied their wealth. It happened in 2008, when retirement accounts were cut in half, while hedge funds profited billions. And it's setting up right now in 2025. The Shiller PE ratio sits at 37, higher than any point except 1929 and 2000. Margin debt has reached $900 billion, matching 2021 peaks. The top 1% of Americans now control 32% of all wealth, the highest concentration since 1929. Retail investor participation is at all-time highs, with record numbers of first-time investors entering at peak valuations. This isn't conspiracy. This is pattern recognition. The data is public. The psychology is documented. And once you see how wealth destruction actually works, you'll understand exactly why most people lose everything. Let me show you the pattern, how it played out in 1929 and 2008, why the majority always falls for it. And what's happening right now that 89% of investors will ignore until it's too late. The pattern has three phases: euphoric accumulation, where the majority buys at the top, catastrophic liquidation where they panic sell at the bottom, and silent recovery where they miss the rebound. Most people focus on the crash itself, the dramatic middle phase. But that's not where wealth gets destroyed. Wealth destruction happens in phase 1 when they buy high, and phase 3 when they stay out too low. The crash is just the mechanism that transfers wealth from the unprepared majority to the positioned minority. Let me show you exactly how this works. Phase 1 is euphoric accumulation. This is when the majority enters the market, driven by fear of missing out, social proof, and authority validation. They don't realize they're buying at the top. Everything feels perfect. In 1929, Phase 1 ran from 1927 to September 1929. The stock market had risen 300% over 8 years. Newspapers ran daily stories of ordinary people becoming millionaires through stock speculation. Shoeshine boys, teachers, factory workers, everyone was buying stocks. Financial experts declared a new era of permanent prosperity. Irving Fisher, the most respected economist in America, announced in October 1929, just weeks before the crash, stock prices have reached what looks like a permanently high plateau. That's Phase 1 talking. Authority figures validating the bubble at the exact top. Why? Because they're part of the system that benefits from keeping money flowing in. Banks were lending money for stock purchases at unprecedented rates. Margin debt, borrowing to buy stocks, reached 12% of GDP. Ordinary investors were leveraging 90% of their stock value. They'd put down $10 and borrow $90 to buy $100 worth of stock. They believed prices would keep rising forever. Radio Corporation of America, the technology stock of the 1920s equivalent to Nvidia today, rose from $85 to $570 in just 18 months. Everyone wanted exposure to the revolutionary new technology. Sound familiar? The majority bought heavily from 1928 through September 1929. They were buying at absolute peak valuations from the insiders and smart money who were systematically exiting. Phase 1 isn't about the majority being stupid. It's about human psychology. When everyone around you is making money, when experts validate the trend, when authority figures say it's safe, going against that consensus feels impossible. The pain of missing out becomes unbearable. So they buy. They buy at the top. In 2008, Phase 1 ran from 2005 to 2007. The housing market had become the wealth creation machine. Home prices had doubled in many markets. Everyone believed real estate only goes up. You couldn't lose money in housing. CNBC ran shows like Flip This House and Property Ladder, celebrating ordinary people making fortunes flipping real estate. Real estate seminars packed convention centers with thousands paying for courses on how to buy property with no money down. Banks offered ninja loans, no income, no job, no assets required. They'd lend you $500,000 to buy a house with zero documentation of ability to repay. Why? Because they immediately sold those loans to Wall Street, which packaged them into securities and sold them to investors. The majority piled into real estate from 2005 to 2007. Investors who'd never owned property bought 3, 4, 5 homes as investments. They used adjustable rate mortgages with teaser rates that would reset in 2 years. They believed they'd sell for profit before rates reset. They were wrong. The Case-Shiller Home Price Index peaked in July 2006. Most buyers didn't realize it at the time. They kept buying through 2006 and early 2007, purchasing at peak prices from builders and investors who were quietly exiting. Ben Bernanke, Federal Reserve Chairman, said in 2007, "The impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained. Authority validation at the top, just like Irving Fisher in 1929. Phase 1 is always the same. The majority buys at peak valuations, validated by authority, driven by fear of missing out, and convinced this time is different. Now let's look at 2025. Phase 1 has been running since 2023. The artificial intelligence revolution is the narrative. Nvidia is the stock everyone must own. The company's market cap increased from $300 billion in 2022 to over $3 trillion in 2024, a 10x increase in under 3 years, just like Radio Corporation of America in the 1920s. The majority is buying AI stocks, tech stocks, index funds at all-time highs. They believe AI will change everything. They're probably right about AI's importance, but that doesn't mean buying stocks at current valuations will make them money. The majority was right about radio technology in 1929. Radio did change everything, but RCA stock fell 97% from 1929 to 1932. Being right about the technology doesn't mean you'll make money buying at peak valuations. First-time investors are entering markets at record rates. Robinhood and other platforms report millions of new accounts. These new investors have never experienced a bear market. They believe stocks only go up. Options trading among retail investors has exploded. Daily options volume is now higher than stock volume on many days. Retail investors are buying weekly call options, essentially lottery tickets betting stocks will rise immediately. Financial media validates the trend. Every dip is called a buying opportunity. Experts say you can't time the market, just stay invested. Authority figures tell you this is normal, healthy, the economy is strong. This is phase 1. The majority is accumulating at peak valuations while the smart money exits. And when phase 2 begins, when the crash comes, they'll be fully exposed with maximum losses ahead. Phase 2 is catastrophic liquidation. This is the crash. But it's not just prices falling. It's forced selling that creates a self-reinforcing downward spiral. Understanding why the crash happens explains why the majority loses everything. Let me show you the mechanics. In 1929, the crash began October 24th, Black Thursday. The Dow Jones fell 11% in a single day. October 28th, Black Monday, down another 13%. October 29th, Black Tuesday, down 12%. In 3 trading sessions, the market fell 30%. But that wasn't the real crash. That was just the beginning. The real wealth destruction came over the next 3 years. The Dow fell from 381 in September 1929 to 41 in July 1932, an 89% decline. Why did it keep falling? Why didn't it bounce back quickly like modern crashes? Because of leverage and forced liquidation. Remember, investors in 1929 had borrowed 90% of their stock value. They'd put down $10 and borrowed $90 to buy $100 worth of stock. When stocks fell 10%, their $100 position was now worth $90, but they still owed $90 to the broker. Their equity, the $10 they put in, was completely wiped out. The broker issued a margin call. Deposit more cash immediately or we sell your stocks to cover the loan. Most investors didn't have additional cash, so brokers sold their stocks. Forced selling. This pushed prices lower, which triggered more margin calls on other investors, which caused more forced selling. A cascade. By November 1929, margin calls had forced the sale of billions in stock. But the majority didn't just lose leveraged positions. They lost everything because they held through the decline. Financial advisors told them to stay calm. It's just a correction. The fundamentals are strong. This is a buying opportunity. President Herbert Hoover announced, "The fundamental business of the country is sound." Authority figures provided reassurance, so the majority held, and the market kept falling. 1930, down another 25%. 1931, down 45%. 1932, down another 15%. Investors who held from peak to trough lost 89% of their wealth. A $10,000 portfolio became $100. Most never recovered. They either sold at the bottom, locking in catastrophic losses, or they held for decades. The Dow didn't return to 1929 levels until 1954, 25 years later. If you retired in 1929, you never recovered. Your retirement was destroyed. In 2008, Phase 2 happened faster, but followed the same pattern. The crash began in September 2007, when the S&P 500 peaked at 1,565. By March 2009, it bottomed at 666, a 57% decline over 18 months. But the mechanics were the same: leverage and forced selling. This time, leverage wasn't margin debt for stocks. It was mortgage debt for homes and structured products. Homeowners who'd bought with 5% down and adjustable rate mortgages couldn't afford payments when rates reset. They defaulted. Foreclosures spiked. Banks seized homes and sold them at auction, pushing prices lower. This triggered more defaults. Underwater homeowners, people who owed more than their home was worth, strategically defaulted. Why keep paying a $500,000 mortgage on a house worth $300,000? They walked away. Banks ended up with millions of foreclosed properties they couldn't sell. Housing prices fell 33% nationally, over 50% in markets like Las Vegas, Phoenix, and Miami. But the real forced selling happened in financial markets. Investment banks, hedge funds, and pension funds owned mortgage-backed securities that were collapsing in value. These securities were bought with borrowed money, leveraged 10 to 1, 20 to 1, sometimes 30 to 1. When values fell, lenders demanded their money back, forced liquidation. Bear Stearns, one of the largest investment banks, collapsed in March 2008 because it couldn't meet margin calls on its mortgage positions. Lehman Brothers filed for bankruptcy in September 2008 for the same reason. And the majority, regular investors with 401ks and retirement accounts, they held through the entire collapse. Financial advisors told them the same things advisors said in 1929: stay calm, don't panic, this is temporary, you only lose if you sell. So they held and watched their retirement accounts fall 50, 60, sometimes 70% depending on their allocation. The average 401k balance fell from $69,000 in 2007 to $50,000 in 2008. But that understates the damage. People near retirement, age 55 to 64, saw average balances drop from $120,000 to $60,000. A decade of savings wiped out. Many couldn't retire. They worked another 5 to 10 years, hoping to rebuild. Some never recovered. And here's the critical point: most of the majority sold at the bottom or shortly after. They held through the decline, then capitulated right as markets started recovering. Why? Because the psychological pain became unbearable. They couldn't watch their accounts drop any further. They had to stop the bleeding. So they sold in late 2008 or early 2009, locking in catastrophic losses. Then they sat in cash through the recovery, too traumatized to reinvest. Now let's talk about what Phase 2 will look like in 2025 or 2026. The crash hasn't happened yet. We're still in phase 1, but we can predict the mechanics based on where leverage is concentrated today. The leverage in 2025 isn't primarily in stocks or housing. It's in commercial real estate, private credit and corporate debt. Commercial real estate, as I mentioned earlier, is financed with mortgages that are maturing and can't be refinanced at current interest rates. When defaults cascade, the lenders are regional banks and commercial mortgage REITs. These institutions will face massive losses. Some will fail. Regional bank failures will cause panic. People will question whether their deposits are safe. Bank runs will accelerate failures. The FDIC will take over failed banks, but the process will be slow and chaotic. Private credit, loans made by non-bank lenders to companies, has exploded from $500 billion in 2015 to over $1.7 trillion in 2025. These loans are riskier than traditional bank loans, made to highly leveraged companies. When recession hits and these companies can't repay, private credit funds will face massive defaults. These funds are owned by pension funds, insurance companies, and wealthy investors. Losses will cascade through the financial system. Corporate debt is at record levels. Investment-grade companies have borrowed trillions at low interest rates. But covenant-light loans, loans with fewer protections for lenders, make up over 80% of leveraged loans. When recession hits, many of these companies will default. High-yield bonds, junk bonds, will collapse in value. Mutual funds and ETFs that own these bonds will see massive redemptions. Investors will panic and withdraw money. The funds will have to sell bonds into a falling market to meet redemptions. Forced selling. Prices will fall further. More redemptions. A cascade. The stock market will fall 50 to 60%, possibly more. The S&P 500 is currently around 6,000. A 60% decline puts it at 2,400. The majority will hold through the decline just like 1929 and 2008. They'll believe their financial advisors who tell them to stay invested. They'll believe the media, which will call every 10% decline a buying opportunity. And they'll watch their portfolios get destroyed. Phase 2 is catastrophic liquidation, driven by leverage and forced selling. It's mechanical, predictable, and devastating to the unprepared majority. Phase 3 is silent recovery. This is where the final and most devastating wealth destruction occurs. Not during the crash, but during the recovery that the majority misses. Let me explain why this is actually the worst phase. In 1929, the market bottomed in July 1932 at Dow 41. By that point, most investors had been wiped out. They'd either sold in panic or were holding worthless positions. But here's what happened next that destroyed their remaining chance at wealth recovery. The market rallied 90% from July 1932 to September 1932. In just 2 months. Investors who'd lost 89% of their wealth saw the market nearly double, and they weren't in it. They'd sold at the bottom or were too traumatized to buy. Why? Because even though the market rallied, the economy was still terrible. Unemployment was 25%, banks were still failing, breadlines stretched for blocks, the news was still apocalyptic, authority figures were still pessimistic. The psychological environment made it impossible for the majority to buy. Every emotional signal said, wait, it'll crash again. So they waited, and they missed the recovery. From 1932 to 1937, the stock market rose 400%. A complete recovery would have restored all their losses and generated substantial gains. But the majority wasn't invested. They sat in cash or in bonds earning 2%, or in gold, while stocks quintupled. This is phase 3. The silent recovery that happens while the majority is paralyzed by fear and convinced markets will crash again. By the time they finally felt comfortable reinvesting, valuations were back to normal levels. They'd missed the entire recovery. The same pattern played out in 2008 and 2009. The market bottomed March 9, 2009, at S&P 666. Most investors were devastated. Retirement accounts down 50%. Home values collapsed. Unemployment hitting 10%. Financial media running 24-hour crisis coverage. And the market rallied 70% from March to December 2009, in 9 months. But the majority wasn't invested. They'd sold during the crash or immediately after. They were sitting in cash, traumatized, convinced it would crash again. Financial advisors during this period reported that clients were demanding to move everything to cash. In March, April, May 2009, while the market was rallying, investors were still selling. They couldn't emotionally handle being in the market anymore. The unemployment rate kept rising through 2009. Housing prices were still falling. News coverage was still negative. Every signal told them to stay out. So they did, and they missed the recovery. From March 2009 to February 2020, before COVID, the S&P 500 rose 400%. An investor who bought at the bottom and held would have quadrupled their money in 11 years, but the majority wasn't invested for that recovery. Studies show that the average investor dramatically underperformed the market from 2009 to 2020. Not because they picked bad stocks, but because they weren't invested. They sat in cash, earning nothing while markets quadrupled. This is why Phase 3 is actually the most devastating. It's where the wealth gap explodes. The smart money that bought at the bottom made fortunes. The majority that sat in cash made nothing. Wealth transferred permanently from the 89% to the 11%. Now let's talk about what Phase 3 will look like after the coming crash. When markets bottom, whether that's in 2026 or 2027, the economic environment will be terrible. Unemployment could be 12 to 15%. Bank failures will dominate headlines. Commercial real estate defaults will be front-page news. Political chaos as voters demand government action. Media will run constant coverage of economic catastrophe. In that environment, even though stocks will be cheaper than they've been in decades, the majority won't buy. They'll be too scared. Every psychological signal will tell them to wait. What if it crashes more? What if we enter a depression? What if my employer goes bankrupt? These fears will feel completely rational. But that's exactly when you must buy. That's Phase 3. History shows with perfect clarity that the market recovers long before the economy does. The stock market is forward-looking. It bottoms when things look worst because it's pricing in recovery that's 12 to 18 months away. But the majority can't think that way. They react to current conditions. So they stay in cash while markets rally 50, 70, 100% in the first year of recovery. By the time the economy actually improves, by the time unemployment falls and news turns positive, stocks have already recovered. The majority finally feels comfortable investing again, but they're buying back in at normal valuations. They've missed the discounted prices. They've locked in permanent wealth destruction. They bought high in Phase 1. They sold or held through catastrophic losses in Phase 2, and they missed the recovery in Phase 3. This is the complete pattern. This is how 89% lose everything, while 11% multiply their wealth. The pattern isn't about intelligence. Smart people fall for it. It's about psychology. The majority cannot emotionally execute the strategy that works. Sell high, buy low. They do the opposite. They buy high because fear of missing out overwhelms them when everyone's making money. They sell low because fear of losing more overwhelms them when everything's collapsing. Understanding the pattern doesn't make it easy to avoid, but it gives you a framework. Right now we're in late Phase 1 heading toward Phase 2. The majority is fully invested at peak valuations. When Phase 2 begins, you need to recognize it not as the end of the world, but as Phase 2 of a predictable pattern. And when Phase 3 arrives, when markets have crashed and fear is maximum, you need to have capital ready and the psychological strength to deploy it. That's how you avoid being part of the 89%. That's how you join the 11% who profit from the pattern instead of being destroyed by it. The pattern is mathematical, psychological, and inevitable. Let me show you why the majority can't escape it and what you can actually do. The mathematics are straightforward. If you lose 50% of your wealth, you need 100% gain to recover. If you lose 89% like investors did from 1929 to 1932, you need an 809% gain to recover. Most people don't understand this asymmetry. They think a 50% decline just needs a 50% recovery. Wrong. This is why staying invested through catastrophic declines destroys wealth permanently for most people. They don't have enough time or capital to recover. A 60-year-old with $500,000 in retirement savings who loses 60% in a crash now has $200,000. To get back to $500,000, they need a 150% gain. If markets recover at 10% per year, that's 10 years. They'll be 70 before they break even. This is why timing matters despite what financial advisors say. The psychology is even more powerful than the math. Humans are wired to follow the herd. We evolved in tribes where following the group kept you alive. Going against the tribe got you killed. This instinct is hardwired. In financial markets, this manifests as buying when everyone's buying and selling when everyone's selling. The pain of watching others make money while you sit out is neurologically identical to physical pain. Your brain cannot distinguish between social exclusion and actual danger. So when everyone around you is making money in stocks or real estate or crypto, your brain screams at you to join them. You feel actual pain from missing out. This is why the majority buys at the top. Then when the crash comes, the fear of losing more triggers the same survival instinct. Your brain interprets losses as threats to survival. The pain is unbearable. So you sell to stop the pain even though rationally you know selling low is wrong. Financial advisors will tell you that you can't time the market, that statistically, staying invested beats trying to time entry and exit points. This advice is based on data showing that missing the 10 best days in the market dramatically reduces returns. But that data is deliberately misleading. Those 10 best days usually happen immediately after the 10 worst days. Their volatility spikes during crashes. If you're out of the market during crashes, you avoid the worst days and catch the best days by buying after the collapse. The financial industry tells you to stay invested because they make money from assets under management. If everyone pulled money out before crashes, financial advisors would lose fees. So they have a financial incentive to keep you invested regardless of valuation. This isn't conspiracy. It's business model. Now let me show you what you can actually do. Most people can't execute the full pattern like hedge funds do. You probably can't short markets or buy complex derivatives, but you can position yourself to avoid catastrophic losses and participate in Phase 3 recovery. Strategy 1. Accept that you don't need to be fully invested all the time. The idea that you must always be 100% invested is propaganda from the financial industry. Warren Buffett holds $325 billion in cash right now. That's 28% of Berkshire Hathaway's total assets in cash. If the world's greatest investor holds massive cash positions when he can't find value, you can too. Right now, in 2025, consider holding 30 to 50% of your portfolio in cash or short-term treasury bills. Yes, you might miss gains if markets rise another 10 or 20%, but you'll preserve capital when the crash comes, and that capital will let you buy at 50% discounts during Phase 3. Strategy 2. Understand valuation metrics and use them to guide positioning. The Shiller P/E ratio, which averages earnings over 10 years to smooth out cycles, is at 37. The historical average is 17. When Shiller P/E exceeds 30, forward 10-year returns are consistently low or negative. This doesn't predict when the crash comes, but it tells you that current prices are extremely high relative to long-term value. Another metric, the Buffett indicator, total market cap divided by GDP, is at 185%. Buffett himself said anything over 120% indicates dangerous overvaluation. These aren't perfect timing tools, but they're clear signals that risk is elevated and holding cash makes sense. Strategy 3. Make a watch list now of quality companies you want to own. When the crash comes, when markets are down 50 to 60%, you won't have time to research. Fear will be maximum. News will be catastrophic. You need to know in advance what you'll buy. What are quality companies? Strong balance sheets with low debt. Consistent, profitable businesses that people need in recession. Companies that have survived previous downturns. Examples: companies like Johnson & Johnson, Procter & Gamble, Costco, Visa, MasterCard. Boring businesses with pricing power and low debt. When these companies trade at 50% discounts during the crash, you buy. You don't try to catch the absolute bottom. You buy when they're clearly cheap, relative to historical valuations. Strategy 4. Recognize that Phase 2, the crash, is actually the opportunity. Your emotional response will be terror. Everyone around you will be panicking. Media will predict depression. Your brain will scream at you to sell or stay in cash. That's the signal to buy. I'm not saying buy on the way down. I'm saying wait for stabilization, then buy aggressively. How do you know when it's stabilizing? You don't, perfectly. But historically, when the market falls 50 to 60% from peak, when volatility has spiked to extreme levels, when fear is maximum, that's been the buying opportunity. In 1932, when unemployment was 25% and the economy was collapsing, that was the buy signal. In March 2009, when Lehman had failed and everyone predicted depression, that was the buy signal. In March 2020, when COVID was going to kill millions and capitalism was ending, that was the buy signal. Every time, buying at maximum fear generated life-changing returns. Strategy 5. Understand that you're fighting your own psychology as much as market forces. The majority loses not because they're stupid, but because they're human. Your emotions will push you to buy high and sell low. Recognizing this pattern in advance gives you a chance to override it. Write down your strategy now in 2025 before the crash. When the S&P 500 falls 50% from peak, I will deploy X% of my cash into the following companies. Make it specific, make it mechanical, because when the time comes, your emotions will be useless. You need a predetermined plan that you execute regardless of how you feel. The wealth destruction pattern has played out twice in modern history. It will play out again. We're in the late stages right now. The majority is fully invested at peak valuations, validated by authority figures, convinced this time is different because of AI or whatever narrative justifies current prices. When the crash comes, they'll hold through catastrophic declines because advisors will tell them to stay calm. Then they'll miss the recovery because fear will paralyze them. This is how 89% lost everything in 1929, how the majority lost half their wealth in 2008, and how it will happen again in the next 18 months. But you don't have to be part of the 89%. You can't control when the crash happens. You can't control how far markets fall, but you can control your positioning. You can hold cash now instead of chasing the top. You can prepare a buy list for when assets go on sale. You can recognize phase 3 when it arrives and have the courage to buy when everyone else is paralyzed. The pattern is clear. The mathematics are simple, the psychology is documented, and the opportunity is coming. Whether you're ready to execute when the time comes, whether you have the discipline to go against every emotional signal and every voice around you, that will determine if you're one of the 11% who multiplies wealth or one of the 89% who loses everything. The pattern is inevitable. Your response to it is not. Choose now which side you'll be on.